Welcome to Talk Tickers. Today, we are staring right into the abyss. You know the one I'm talking about. It's that nightmare scenario that every single investor has sort of tucked away in the back of their mind. You know, it's a Tuesday morning, you pour your coffee, you open your brokerage app to check your positions, and the screen is just blank.
Or a spinning wheel.
Yeah.
Or worse, a press release that the firm has just ceased operations.
Exactly. It's the ultimate tail risk.
It is. We spend so much time analyzing market risk, volatility, earnings, what the Fed is going to do next, that we totally neglect counterparty risk, the risk that the platform actually holding your money just fails.
And the goal for this deep dive isn't to scare anyone. It's actually the opposite. We want to look at the structural protections in place.
We're going to open up the plumbing of the market.
Yes, specifically the interplay between the Securities Investor Protection Corporation, SIPC, and the FDIC. We want to understand what actually happens.
Because the safety net is, well, it's a lot more robust and frankly more interesting than just saying it's insured.
It's way more interesting. Most people think of SIPC as just, FDIC for stocks.
And that's just a fundamental misunderstanding of the mechanics. They are.
Yeah.
They're different beasts entirely.
Okay, so let's start right there, the snapshot. If we boil this down to the absolute basics, what is the difference between that sticker you see on a bank window and the one on a brokerage website?
The fundamental difference is the nature of the guarantee and who is backing it up. The FDIC insures bank deposits. It's backed by the full faith and credit of the U.S. government. I mean, that's the gold standard.
Right.
If a bank fails, the government guarantees your cash up to the limit. SIPC, on the other hand, is not a government agency. It's a nonprofit membership corporation.
Which I have to say sounds a little terrifying. Membership corporation just doesn't have the same ring as federal government?
It sounds less secure, I'll grant you that, but the mechanism is different because the whole business model is different. Well, SIPC protects securities and cash at brokerages. But here's the critical nuance. It's not really insurance in the way you think. It doesn't protect the value of your stocks.
It protects the custody of them.
Exactly, the custody.
So let's be crystal clear. If I own, say, 100 shares of a tech company and that company goes bankrupt because their product was a dud, SIPC does nothing.
Nothing. That's just market risk. You made a bad investment. SIPC has zero to do with that.
Right.
But if your brokerage goes bankrupt and for some reason your 100 shares of that tech company are missing from your account, just gone.
Then SIPC steps in.
And then SIPC steps in to replace the number of shares you had, not the dollar value they had at the moment of collapse.
So it restores the inventory, not the price.
You got it.
And this brings us to, I think, the most important part of this whole thing, the primary mechanism for safety. It's not actually the insurance.
No, not at all. The real hero of the story is segregation.
Asset segregation.
Yes. A specific regulation, Rule 15C33, forces broker-dealers to keep client assets completely separate from the firm's own money.
It's not like a bank, right? When you put money in a bank, they take it and lend it out.
Right. They're leveraging your cash. It becomes a liability on their books. But at a brokerage, when you buy a stock, that stock is yours. It sits in a metaphorical segregated box.
So the broker can't use my stock to pay their rent or their bonuses?
They absolutely cannot. So in a perfect world, if a broker fails, they just hand you back your box. SIPC is only there if the broker broke the rules and, stole from the box.
So it's a cleanup crew for fraud or a massive record-keeping failure?
That's the perfect way to put it. And the limits reflect that. SIPC covers up to $500,000 total per customer, and of that, up to $250,000 can be cash.
But again, that only matters if the assets are actually missing.
Exactly.
Okay, we need to understand why this system even exists, because it wasn't always this buttoned up, right?
Oh no, it was an absolute mess. To really get it, you have to go back to the late 1960s, a period known in financial history as the paperwork crunch.
I love that name. It sounds so analog.
It was incredibly analog. Between 68 and 70, trading volumes just exploded. The market was booming, but the infrastructure was, it was ancient. We're talking about physical share certificate.
Like actual paper. Messengers running around Wall Street.
Literally, runners with bags of paper.
Yeah.
And the back offices, they just couldn't keep up. Record keeping totally broke down. They'd trade stocks all day, and at night, the clerks couldn't figure out who owned what.
That's terrifying. So you'd buy a stock and the broker might not even know if they had it.
It was chaos. Transactions were wrong. Firms couldn't meet their obligations. And because of this, hundreds of broker-dealers either merged or just went out of business.
And public confidence must have just cratered.
It did. People weren't losing money on bad stock picks. They were losing money because the firms lost the paperwork.
So Congress panics, rightfully so, and passes the Securities Investor Protection Act in 1970.
Correct. That's what created SIPC. And more importantly, it ushered in these strict regulatory rules. That Rule 15C33 I mentioned, the Customer Protection Rule, that came from this mess.
And the track record since then has actually been pretty amazing.
It really has. I mean, let's look at the biggest stress test the system has ever faced. Lehman Brothers in 2008.
The big one.
The largest bankruptcy in U.S. history. And people forget, Lehman wasn't just an investment bank. They had a huge brokerage arm. When the parent company went under, there was panic.
I can imagine.
But the trustee, within weeks, transferred 110,000 customer accounts. That was $92 billion in assets.
Within weeks. For a bankruptcy that size, that's incredibly fast.
Incredibly fast. And the payout.
What was it?
100%. Every single brokerage customer got their property back.
Because of segregation.
Because of segregation. The firm failed, the parent company collapsed, but the customer boxes were safe.
Okay, but what about the villain of the story? Bernard Madoff. Same year.
That's the other side of the coin. That wasn't an operational failure. That was a Ponzi scheme. That was theft.
The assets were just missing. They never existed.
Exactly. And that's where SIPC stepped in. The recoveries there have now exceeded $14.5 billion. It took longer, obviously, because it was a crime scene, but the mechanism worked.
And you had MF Global in 2011, same story.
8th largest bankruptcy. Again, a 100% distribution to customers. The stats are clear. In 99% of eligible cases, investors got their investments back.
So the nightmare scenario is statistically more of a headache than a catastrophe.
It's an inconvenience, a big one, for sure. You might be frozen out of your account for a few weeks while it gets transferred, but the capital preservation is extremely high.
Okay, let's pivot to the investor context then. We know the net is there. Now I want to understand the plumbing, because there are ways to use this system to your advantage. First, let's talk about street name.
This is a concept that confuses a lot of people. When you buy a share of Apple, you don't actually get a certificate with your name on it anymore.
It's held in street name technically by Seed and Company, right?
Yes, which is basically a part of the DTCCC. So the brokerage holds the stock on its books, and you are the beneficial owner.
And some people hate this. They think, if I don't hold it, I don't own it.
I get that it feels abstract, but in a failure, street name registration is what saves you.
How?
Because the records are centralized. Regulators can do what's called a bulk transfer. They can take 1 million accounts from failed broker A and just slide them over to solvent broker B in a matter of days.
So if everyone had physical paper, it would be a nightmare to verify.
It would take years. So it's speed versus tangible control. In a crisis, you want the speed.
I'll take the speed.
Yeah.
Okay, let's talk about the limits again. $500,000. That might not be enough for some people.
Huh?
How do you get around that cap?
You have to understand the idea of separate capacity. The $500,000 limit applies to each separate capacity you have at a firm.
Unpack that for me. What counts as a separate capacity?
Okay, so you as an individual are one customer, one capacity. But you and your spouse with a joint account, that's a second separate customer.
Right.
Your Roth IRA.
That's a third.
That's a third. Your traditional IRA, that's a fourth.
So if I have $500K in my individual account, $500K in a joint, and another $500K in my Roth, I'm actually fully covered for $1.5 million.
Exactly. SIPC sees those as 3 distinct legal entities. But, and this is important, if you just open 2 individual accounts at the same firm, they get added together. You don't get double coverage.
Got it. The structure matters. Now, cash. The SIPC limit is only $250,000, but I see brokerages advertising FDIC coverage up to $3 million.
Yeah.
How are they doing that? They're not banks.
This is the cash sweep program. It's standard practice now. And they are effectively performing a little bit of regulatory arbitrage for you.
Arbitrage is a strong word.
But it fits.
Right.
When you have uninvested cash, the broker automatically sweeps that money out of the brokerage and deposits it into a partner bank. Or, more likely, a whole network of them.
So the money leaves SIPC jurisdiction and enters FDIC jurisdiction.
Precisely. And since the FDIC limit is $250K per depositor per bank, the brokerage just splits your money up. If you have $1 million in cash, they might put $250 into bank A, $250 into bank B, and so on.
They're daisy chaining the banks to stack the insurance.
Exactly. And for you, it's seamless. You just see a cash balance. But Behind the scenes, that money is sitting in a dozen different banks, all fully insured by the government.
That's a pretty critical distinction. And what about excess SIPC? I've heard that term. Is that a real thing?
It is. The major firms, Schwab, Fidelity, the big players, they buy private insurance.
Yeah.
Often through Lloyd's of London.
The classic.
The very same. This insurance kicks in if the SIPC limit is exhausted.
Is there a cap?
The catch is that it usually has an aggregate cap for the entire firm. So the policy might cover customers up to, say, $1.9 million in cash individually, but have a total payout limit of $600 million for the whole brokerage.
So if the fraud is, $10 billion, that $600 million isn't going to go very far.
Right. It gets diluted pretty fast. It's a nice to have, but the segregation rule is still your primary defense.
Okay, we've talked about what is covered. Let's be explicit about what is not covered. Crypto.
Generally, no. Unless it's a registered security, crypto assets aren't protected by SIPC or FDIC. If an exchange goes down, you're likely just an unsecured creditor standing in line.
Commodities. Futures.
Usually not, unless they're in very specific types of accounts.
And the big one, a market crash.
I cannot stress this enough. If your broker gives you terrible advice and you lose 40%, SIPC pays you zero.
Right.
If a broker steals your shares, SIPC gives you the shares back. If those shares are worthless when you get them back, that's your problem. SIPC restores the inventory, not the market value.
That is the bumper sticker right there. Restoring inventory, not value.
And we should touch on the timeline. We said Lehman was quick, but quick in legal terms can be frustrating.
Right. If I need that cash for my mortgage next week, a bulk transfer taking 3 weeks is a big problem.
That's it, exactly. In a clean failure, it's days or weeks. But if the records are messy, like a Madoff situation, you're filing claims with a trustee. That can take months.
So liquidity risk is real, even if the risk of total loss is low.
Very real. Institutional diversification is a valid strategy. Don't keep all your eggs in one basket, and maybe don't keep all your baskets at one firm.
Okay, we've covered the history, the plumbing, the limits. I want to drill down to one final, very specific decision point for our listeners.
The sweep option.
Right. And that brings us to
the one question.
The one question you should ask yourself about your brokerage account today is this. Is my uninvested cash held in a bank sweep or a money market fund?
And here is why it matters so much. A bank sweep offers FDIC protection. Your principal is guaranteed by the U.S. government. A money market fund, on the other hand, is a security.
So it's protected by SIPC.
It is, which means you're protected against the shares of the fund going missing. But you are not protected if that fund breaks the buck or loses value itself.
And that's a subtle but massive difference in a crisis. I want the government guarantee on my cash, not a fund share that usually stays at $1.
Exactly. For most people, the bank sweep is the safer default for cash.
Let's wrap this up. We started with the nightmare scenario, the blank screen. But what we found is the system is actually designed with a lot of redundancy.
It is. Between the segregation rules, which are the real hero, the SIPC backstop, and the FDIC pass-through coverage, the infrastructure is incredibly robust.
We are definitely not in the 1960s anymore.
Thankfully not. That centralization, which feels less tangible, actually makes the whole recovery process faster and more reliable.
But the final thought for me is ownership.
Yes. It's so vital to remember a brokerage is a custodian. They are holding your property. The whole system is designed to make sure your property doesn't become their property just because they made bad business decisions.
Unless you're trading crypto, in which case.
Always read the fine print.
Thank you for joining us on Talk Tickers. Hopefully you can sleep a little better tonight knowing that even if your broker goes bust, your box in the vault is likely safe.
Just don't lose your password. SIPC can't help you with that one.
Very true. We'll catch you next time.